Can everyone hear me? Okay. Good afternoon, everyone. Thank you for joining us. Welcome to the latest installment of Tax Analysts Conference Series. I'm Ariel Greenblum, Editor-in-Chief of Tax Notes magazine, your moderator. Tax Analysts is the nonprofit publisher of Tax Notes and other print and online products. This is our 15th year of live forums on tax practice and policy. If you are new to our events, let me say welcome. And to those of you who attended a prior events, let me say welcome back. Today's discussion will focus on what tax reform for small businesses should look like. Republicans control the White House, the Senate, and the House of Representatives. But will Congress succeed in overhauling the Internal Revenue Code? Should pass-throughs continue to receive tax-favored treatment? I'd like to take a moment to explain our process. After my introductory remarks, I will hand it over to our panelists. Together, they will address specific questions on small businesses and tax reform. After that, we will open up the discussion to all of you. I know that everyone has a lot to say on this topic, but I will be the one keeping track of the conversation. We are recording this event for viewing on our website, taxanalysts.org, where it will be posted for posterity. For media purposes, we are on the record. For that reason, when we recognize you to speak, please tell us who you are and what organization you represent. Before we proceed, I want to recognize those who helped make this conference possible. Mindy Herzfeld, Director of the L.LM and International Tax Program here at the Levin College of Law and of Counsel at Ivins, Phillips, and Barker. Thank you, Mindy, for helping us organize this conference, and thank you, Levin College of Law, for hosting it. It's an honor to be back in Gainesville, where I received my J.D. in Tax L.LM, and I would like to extend a special thanks to Professor Dennis Calfee for getting me through it. I would also like to thank the American Bar Foundation, Tax Analyst co-sponsor of this conference, and our panelists for sharing their time and expertise. Now I'd like to introduce them.
You forgot to say I'm a contributing editor at Tax.
And I forgot to add that Mindy is a contributing editor at Tax Notes International. So our panelists. This group provides their studied views from the small business perspective, and we are delighted to have their company. To my immediate left is Mindy. Seated next to her is Greg Rosica, a partner in EY's Southeast Region Private Client Services Division, whose practice focuses on closely held family businesses. Next to him is Steve Looney, chair of Dean Mead's Corporate and Tax Department, and the former chair of the American Bar Association Section of Taxation's S Corporations Committee. And finally is Debora Correa Talutto, a transfer pricing manager at Tenemos, a Swiss banking software company. Mrs. Correa Talutto is pursuing her doctorate in judicial science here at the Levin College of Law. Now, as Professor Calfee would say, let's commence. Why do small businesses care about tax reform? Panel.
So, thanks, Ariel. I think small businesses care about much different things than large businesses. And the interesting thing here about the whole conversation that's taking place about tax reform is that a lot of it has started, a lot of the conversation for the past 10 years has really been about corporate tax reform and international tax reform. But since the conversation has gotten more serious with President Trump's election and the Republican-controlled House and Senate, the conversation has shifted a little, I think, from this almost sole focus on corporate and international reform to how the role that small business tax reform plays within the larger context of tax reform. And what you hear from small business as to what's important to them in tax reform is really much different from what corporate and multinationals had been saying was important to them. There are some overlaps, but it's really a much different conversation. And so what comes out of a lot of the statements from small business advocates for tax reform for small business is, I think, number one, is the complexity of the rules. And so for the tax rules are complex for everyone, but for small business, proportionately, it's obviously a much higher cost per dollar earned is spent in complying with the tax laws. Small businesses also don't have the resources that larger businesses do to figure out what the tax rules require them to do, especially if they're starting up and have some great idea and making a couple sales and gosh, didn't realize I would be so successful. And then there they are and didn't realize they actually had tax filings to do and forms to fill out and estimated payments to make. And so complexity, I think, is a number one big issue for them. I don't know if you all agree.
Yeah, I wanted to add a little bit, just, I guess a little bit of flesh onto that. When you talk about small businesses, if you look at the choice of entity statistics, and I look at them a lot because I talk about pass-through entities, what you'll find, and these are statistics from the IRS, in 2016, you had, I got it in front of me, can't read it very well, but about 4 million partnership tax returns filed. You had about 4.8 million S corporation returns filed, which a lot of practitioners find very surprising. That's why I always like to go over these. But you know how many C corporation returns you had filed? You had 1.8 million, okay? And that does not take into account all the businesses run through sole proprietorships or disregarded LLCs that are taxed as sole proprietorships. So what you're really left with is the majority of America's businesses are run through pass-through entities and through sole proprietorships or single-member LLCs that are disregarded. So to ignore them and to focus on this small little finite universe, and again, I think they're really looking at the multinational publicly traded corporations and just to lower corporate tax rates, I think is a big mistake, and any tax reform has to be really comprehensive.
And I think also, when you talk about small businesses, the majority of taxes are paid by individuals in this country, right? When you look at where the tax revenues come from, it's not corporations. It's not the big companies that you think about. And so, it's not just because they're all you and I all paying taxes. It's because a lot of those businesses come through and get paid on the individual's tax return. And so that's the mechanism to pay those. And it's really the backbone of our country, right? These small businesses that are here.
So I think you just heard why the conversation has now shifted from one about the need for corporate and international reform to why reform has to take into account the needs of small businesses. I think, Deborah, is your the company you work for is also is a
No,
you call it a
it's
small
a
business? It's a larger-
multinational
okay.
C corporation. Yes.
Okay,
You're
so
all for corporate tax reform.
So I think complexity is number one. The other thing that I hear, well, the rates is a big one. People talk about the need for lower rates. Out of $1 of income earned, they're paying 50 cents in just income taxes. Forget the payroll taxes and the sales taxes. So a lot of talk about the need for lower rates on pass-through or small business income. The other big thing I keep hearing is the uncertainty in the tax rules. And this includes a lot of different components, but I think people are concerned about frequent law changes, not knowing how to comply. And this could be statutory changes, regulatory changes, and then also if you're managing a small business as a pass-through and you've got to make estimated tax payments, a lot of questions about just how to comply. And so that's another big one I'm hearing. The other concern that has always been mentioned as an issue for small business and the need for reform to accommodate those businesses and family-owned businesses is repeal of the estate tax. That's regularly mentioned as an issue. The last point I'll say here, because I do think it's the most problematic, is the need for fairness, and that kind of goes to what you were saying, Steve. Why just talk about reform in the context of corporates and multinationals when so many more businesses in the U.S. Operate as pass-through, so many more just by number, and these are the businesses that are generating jobs, and why should these businesses which hire more Americans, why should we be either raising or not lowering their taxes while we're giving corporates and multinationals a tax break? And so that's regularly mentioned as a point to advocate for small business tax reform. The issue there, I think there are a couple of points on that fairness issue, which some of my panelists may disagree with.
As I told my kids, I don't like the word fair to start with, so
Well,
it doesn't have to be fair.
Fair is a very challenging word.
Nothing's fair, but
Fair is a very challenging word in the context of figuring out what the right amount of tax someone should be paying is, but it's also a word that gets thrown out a lot, and we've also heard it a lot in discussions of the need for small business tax reform, or why should we have corporate tax reform without small business tax
Right.
reform?
So one way of discussing, like putting that fairness question into context is this corporate integration concept.
Ariel just cut me off.
I did,
you just got cut out.
proudly.
I heard it.
So, Greg, how would a corporate integration system work?
Sure. So anyone know what a corporate integration even is? So this is concept, right? So part of tax reform is about making things simple, right? It's about which if at the end of this you guys think what we talked about was simple, please let us know.
Let us know,
It'll
yeah.
be interesting. It's also about making things more competitive, right? So making companies more competitive across the globe. One of the other big tenets of what we're trying to do in tax reform. So, we talk about simplicity. It's trying to narrow rate brackets, have fewer brackets, have, less deductions, things like that, so tax returns can be done quicker. But when you talk about, kind of the corporate tax integration, all that means is that when you look at a big company, a big C corporation, and how it gets taxed, it pays its own tax rate, right, around 35% top rate. But then when it earns money, and it pays it out to all its shareholders. So when you guys buy stock, shares of public company stock, if you get a dividend check, you have to then turn around and pay tax on that dividend. So not only did the company pay tax on its earnings, but then the shareholders, the owners of the company, then paid tax on the dividends that were distributed out to them. And so then you get this concept of, well, if I'm going to pay tax twice on these earnings, does that really make sense? And can I do something different and structure my company maybe where some of this is offshore? I use foreign companies to do these kind of things, and so some of those earnings aren't necessarily taxed at the high U.S. corporate rate, and then some of those earnings might not come back onto shore, and so we can minimize those taxes. And so the idea of corporate integration, corporate tax integration, is to get rid of some of that double layer of tax and to make things, I want to say simple, but to have it just taxed less so that there is a little bit more competitiveness of companies that are multinational. But it's not just multinational, right? It's U.S. companies. Just if you're U.S. only, you're in that situation. So if you chose, a non-flow-through, a non-pass-through type of entity, and I have a great joke on pass-through entities, but we'll tell it later. If we look at a C corporation and how it's might even be off color. So when you look at that, a C corp just that operates here in the U.S., that maybe it was just the way the company was founded years ago by a great grandfather, and set it up as a C corporation, because there was a time when some of these pass-throughs actually didn't exist. Not in our lifetime, right? Or maybe right before.
Well,
that.
I'm a little older than you probably, but no, I didn't start practicing before the repeal of the general utilities doctrine. So
Yeah. So anyway, so the proposals are out there. So Hatch is the one that's proposed this idea of this corporate tax integration. It's been out there. I really haven't heard a ton about it in some of the recent areas. So I'm not sure how it's going to resurface and come up. But the idea is, maybe looking at some of the dividends and how those are taxed, and either not having them taxed or having a credit available for the shareholders that receive the dividends, or giving the companies a deduction for it. A lot of this kind of how you get to the end of the answer is probably less important than what the answer at the end of the day is. So,
and Greg, do you really think they're talking about true corporate integration would be a flow-through entity,
Right,
one level
yeah,
of tax.
exactly.
I still think they're
for corporations and partnerships.
right.
Yeah, one
right,
For
right.
every business.
Yeah.
For every business, and I still think, and you mentioned some options, but I still think they are contemplating some tax on dividends.
Yeah,
And there is a differential. Publicly held corporations, although the management and employees may own some stock, it's usually just investors out there, as opposed to a closely held business where the dividends are going to the owners as well as the wages.
Right.
On the point of where it's going, I have a quote from Senator Hatch from this morning's hearing where he said,
That's up to date.
Yeah, this is up to date.
That passes anything I got.
I continue to believe that corporate integration can solve many of the problems we are trying to solve with comprehensive tax reform. So I think he's
Okay.
still pretty devoted to the idea of corporate integration.
All right. Well, I can't wait to see his plan.
Yeah.
If
But
he ever
can I
releases
can I
something.
ask you a question on that? If corporate integration is important because there is this double level of tax on corporations and shareholders that isn't faced by pass-throughs, how I struggle to make sense of the claim from pass-throughs that they're disadvantaged relative to corporations if you lower the corporate rate but not the pass-through rate.
Well, that depends on how much you lower the corporate rate and what you do with those dividends. Right now we have a 20% maximum dividend rate. If they knock it down to 5% and knock corporate taxes down to 15%, maybe C corporations do become more advantageous than pass-through entities when you look at the effective, combined tax rate.
And
Yeah, I think though that's, when we look at corporate rates potentially going down to 15% in some of the plans, or 20% and 25% in some of the others, if that happened, and ordinary rates for pass-throughs or for individuals, are slightly tweaked. And so today we've got 7 or 8 different tax brackets for all of us. They're talking about going down to maybe 3. So if we went down to 3 and the top one's still 33% is proposed out there, and 33, and I'm an accountant, right? So I can do math. 33 is higher than either 15 or 25. I know that for a fact. And
Even I
that
can
will
do.
stay true no matter what. But that's higher. So if all of a sudden I'm a flow-through entity or own one, and I'm paying tax at 33%, as a C Corp, I can pay tax at 15%. Is that where I want to be? I'd still maintain the answer is going to be yes, but
I would tend to agree, but the tax laws as they've been for the last 30 years have encouraged everybody to go into pass-through entities, and it's just going to be a big disruption if then we have to have a change here.
do you think that's the biggest issue, the disruption?
Well, I think it presents complexity, and then I'll answer in a later question, I think there's a great opportunity once you get in C Corp form to raise the rates, and you're stuck for a number of reasons.
Okay. Steve, is it right that a one-person S Corp should benefit from a decreased rate?
That a one-person S Corp should benefit from the rate?
From any rate reduction?
Well, my answer is an unequivocal yes. It is absolutely, and with a caveat, it depends on the facts and the circumstances. You could easily have a single member-owned S corporation or partnership that is a manufacturing outfit, and they could be producing, because seems to be the reasoning of Mnuchin, that they will produce lots of jobs and good wages for people. Could be lots of invested capital in a single member LLC. That doesn't necessarily limit it. And, one of the things I wanted to mention, just with respect to maybe some case law we've seen in the reasonable compensation area, The service certainly believes that even service entities can produce a lot of profits not attributable to personal services rendered by the owners. We've seen that in the Mulcahy case, accounting firm, where they reclassified wages as non-deductible dividends. We saw it in the Brinks case in a law firm. So yeah, I certainly don't see any reason why, you have one entity has one owner, we're going to tax them at a different rate than it has two or more. And that kind of just brings me back to there was a provision in the American Jobs and Closing Tax Loopholes Act of 2010. I don't know if you all remember this, but it came very close to passing. And it was a provision to impose on all pass-through entities, this was dealing with the self-employment tax on any entity, pass-through entity, that was in the professional services business if it had 3 or fewer shareholders. Well, there is some logic to that, but gee, what a disadvantage you put the smaller guys to compared to the bigger guys when you do that.
I think the bigger problem is that I don't know what you mean when you say small. Or I don't know
Well,
what
that's
you
right.
mean when you say
That's-
one person. I know what that means, but I have several clients and companies I work for that there is one shareholder and it's a multi-billion-dollar company. And
That's right.
and then but I think what happens is I've seen in the media that sometimes things get spun a little bit, right? So it's not always what it sounds like. I saw
No.
that. I saw it happen. I did.
That can't be true.
No fake news. here.
Honest truth.
Fake
Um,
news, right?
But when so these things get a little bit sensationalized when you talk about this one person entity. Well, my mind when I hear that goes to this it's the corner cart that kiosk that exists out there that someone's running their business. But I can show you example after example of like I mentioned, multi-billion-dollar companies with thousands of employees that have one shareholder that own a pass-through company. So we need a little bit more definition, I think, around some.
No,
of what this
I would
is.
agree with you. Every day we see what they would call small if it has 3 or 4 shareholders, but the revenues may be tremendous, hundreds of millions.
Do you think the lines are like small versus big, or pass through versus core? Or, like, where do you see the tension?
I don't know what the lines are. I think when you look at what makes sense, and I won't use your F word. I'll use the equitable word, fair.
Oh,
the other
fair,
F word.
that's what you're referring to. Oh.
Everyone looks shocked at the minute. Yeah, fair was her word. Just to be clear, when you look at that,
Oh, you're talking about fake.
when you look at that, I think it has to do with how much are the companies making? I mean, we have bracket systems, right, with different brackets that you move up through, and that puts in a level of equality in there. In that, those that are bigger and make more and those kind of things pay more on those incremental earnings and those kind of things. It doesn't have to do with. I don't know how you define a one-person company versus a 5-person company without looking at revenues and taxable income and all of those kind of things.
Yeah, I agree that I think that we need to start looking at the revenues to determine what is really small business instead of looking the ownership. And we can take an example with BEPS, where we leveled out certain requirements for bigger companies, bigger multinationals, due to the revenues. And we need to look into that to determine what we are going to consider small businesses.
And that example exists in your world all over, right? I mean, there's a lot of things that apply to companies at different either revenue levels or employee levels that I'm sure you deal with.
Exactly.
Well, Mnuchin, like his whole philosophy is if we decrease the tax rate for everyone, then that's going to lead to more jobs for people. So if we are concerned about that, then maybe like is the one person owner of a business, if we decrease their rates, are they going to hire more people, or should we give a wage credit? And would that be the better way of tailoring the mechanism to achieving the policy goal of more employment? I don't know.
Well, I think if you if you lower taxes, you create more capital for a company, right? So they pay $1 less of tax, they have $1 more to do something with. So by lowering taxes, you create capital. Now, how that capital gets deployed is then up to the company, right? And so if you do things like wage credits, now it's not up to the company. Right. It is because they get a better benefit by deploying it through personnel. if they have 100% expensing, so you buy a desk or you buy a computer, today you generally have to write that off over multi-years, but this expensing, 100% expensing concept is you just get to deduct it all right away. And so, now am I going to spend my dollars there? So by having those provisions, you can perhaps help guide or direct where that dollar of capital goes by lowering the rate.
Well, and while we're on that subject, what's small, what's large, who should get the benefit of this and that. Of course, for one thing, graduated tax rates do address that issue to a certain extent. But I'd be remiss if I didn't quote Mr. Mnuchin from a few days ago, where he said, if you're an accountant firm, and that's clearly income, you'll be taxed an income rate. He means as opposed to a special business rate for pass-through entities. It wasn't real clear. You won't be taxed at pass-through rates. Then he says, if you're a business that creates manufacturing jobs, you're going to get the benefit of that rate because that's going to be passed through to help create jobs and better wages. Well, I don't know where Mr. Mnuchin's been, and not to make this political, but
On his yacht.
our economy, as you all know, has been becoming increasingly more service-based economy versus a manufacturing economy. And to say that service-based industries don't create jobs and they don't pay wages, as some folks said, that their mouths just dropped when that statement came. I mean, not that it was unexpected.
I don't know why he had to pick on the accountants.
Well,
That wasn't
I
very fair.
I'm glad he didn't say lawyers.
He didn't mention the investment bankers.
That's
Yeah,
right,
but
yeah.
believe, he got the carried
carried
interest.
interest.
Carried interest on
Oh, he does.
investment
I
bankers.
think the his latest comments on carried interest are that it's going away, or you'll be taxed on carried interest if you're a hedge fund, but it's okay if you're a private equity firm to get a lower capital gains rate because private equity funds actually create jobs. They invest in companies that hire people.
And that's
So
exactly what he
that's the-
said. Yeah.
That's the same logic. I don't. Why would you make that comment? Why would you want to draw that distinction? And
Well, it's an easy source of revenue if you want to tax certain, service providers at a higher rate. But again, I think that's a terrible way to do tax reform by picking winners and losers depending on what industry you're in. I just don't think that's a sensible approach.
Yeah, and I think along the way, when we first even started talking about tax reform and being in a service industry, and I'm a partner in a large partnership at Ernst & Young, we never thought for a minute when they talked about lower rates on pass-through that it was going to apply to us, right? So not for a minute did we think that, and I guess it was validated that will never happen to us. But but it made a little sense in that if you think of a true service partnership that doesn't create, and we do a lot more of this now. We're not just hourly billing type firm anymore, but if you collect $100 of revenue from a client and you pay your payroll costs and you have your remaining amount and it gets split amongst the partners at the end of the day, it's in essence your wages and your salary. I mean, there is some return of capital that's there, and so that's the thought behind it. And
I understand that thought, but as I said, pointed out before, there's a number of cases out there in the C corporation context that said, oh yeah, you're a service firm, but you can nevertheless generate profits. Right. And they recharacterized wages, deductible wages, as non-deductible dividends. And then I think also from a tax policy standpoint, I understand in the S corporation area, of course, the thing is, can you pay unreasonably low compensation to your shareholder employees, right, or will it get reclassified as, the subject to self-employment tax?
And you would do that to avoid employment taxes.
Right, you do that to avoid self-employment tax.
Unless you're living in the place where we just beat the team last weekend, Tennessee, it's actually the opposite.
No, I know there are some states that are absolutely different, but I guess my point there is, I understand the rationale for that in the sense that Social Security taxes, self-employment taxes were meant to apply to earnings derived from amounts received for personal services rendered. you almost have to question, we're going to do tax reform. Why do wages get taxed at a higher rate? What about the middle income people who that's all they got? They don't own a business. They're getting wages. They could really get hit by that. And I know there's still graduated tax rates, but I think that could create a problem.
And there's certainly, not to beat this thing to death, but there is,
But
I think
we
we have,
will.
we already, I think we have. But just one last comment is that even in the C Corp world, there already is this precedent for what we're talking about, right? Because if you're a service company and you're a C corporation, you're oftentimes a personal service company. So if you're a law firm or whatever and you're a C corporation, so and what that means is you don't get the benefit of lower tax rates. You go right to the top, 35% rate. That's what it all is at. So there is some level of precedent for this.
There's precedent, except everybody zeroes out their income in C corporations if they're personal service.
But I think that the question you asked, Ariel, is also playing out about whether lower rates are better than targeted incentives for the particular social policy goals. I think we're hearing that a lot in the debate over expensing, but it also raises a question of how much you want to use the tax rules to advance your social policy goals, and that really conflicts with what the Republicans have been saying since they released the blueprint last June, that their primary goal in tax reform is simplification. And so finding all these different goals, many of them very worthwhile, that you want to use the tax rules to accomplish, really runs head on into simplifying rules and graduated rates also, same thing. And what's striking is listening to the hearings and the testimony and the questions that are being asked to the witnesses by the congressmen and by the senators on Ways and Means, Senate Finance this morning, that everyone has their own favorite deduction and incentive.
That's
and
why the tax code is so long.
Yeah, right.
I mean,
right. So the two goals completely conflict, and so lower rates will always get you simpler, and wage credit will get you job growth more if that's what you want to use the tax rules for. But it's also not clear to me whether wage credit will help those who seem to be most vulnerable in society now, and those are people who are really seem to be unemployable. And when we talk about really one of the biggest social issues facing the country, the opioid crisis, a lot of the people who are struggling with that crisis, I'm not sure that a wage credit would help them. And so do we want to expend our energy with various tax tools where it's not clear how effective or not they might be, or when the problem with the people we need to help the most, those tools may or may not help.
I would agree with that, but maybe that's something that has to be addressed independently of the tax code.
Right. I'm saying, do we, what are our biggest social problems?
Right.
What tools should we use to address them? And let's keep the tax code simple and use more targeted social policy
Right.
tools.
That's not to say the tax code hasn't been used for social.
It's as Ariel
all
says,
throughout the code.
that's why it's so long.
okay. Should pass-throughs receive favorable tax treatment at all when they can simply incorporate?
Okay.
All right.
I'll take a stab at that.
Thank you, Steve.
Since you wanted me to. Well, and I guess the first thing to recognize is, for S corporations, I mean, it wouldn't be incorporated and just be revoking the S election. So same idea, though. But I guess the second point we've talked about a little bit, and that is you're still, depending on what the details are, going to have a double tax on the earnings of C corporations potentially, as well as a double tax on the sale of assets of an S corporation, whereas you don't with an S corporation or a partnership. So I think that at least is one of the primary reasons why just incorporating, now you're subject to potentially, again, depending on the details, a double tax regime. So I don't think that necessarily solves it. But that, and again, when you have a sale of assets and you have a pass-through entity, and we have such a favorable capital gains rate, although some people may think it may be lower, I think it's a pretty favorable rate at 20%. That's hard to beat, you know, and if you materially participate in the business, you don't get stuck with the net investment income tax of 3.8% either. And again, with the closely held businesses, we are usually looking at owner employees who materially participate in their businesses. Now, the other reason why I don't think that's necessarily a great solution, okay, I got to pass through, I'll incorporate it, is what I alluded to earlier. That is, okay, we go ahead and we convert to C corporation status, and then the next administration comes in and raises corporate tax rates, all right? Well, there are a number of either prohibitions or at least what I would call toll charges when you want to go from C Corp status to a partnership, S corporation, or sole proprietorship. When you're looking at going from a corporation to a partnership or sole proprietorship, I think you all know you're going to have a taxable liquidation. And that's a severe penalty or toll charge for going back to that form of entity. With S corporations, you have 1362G, which generally prohibits you from re-electing S status within 5 years if you voluntarily revoked it. And then you have a whole host of other things. You have to deal with the built-in gains tax. If you were a C corporation, you might be subject to the LIFO recapture tax. There are different distribution rules if you have accumulated subchapter C earnings and profits. And you have passive investment income rules to worry about if you were a C corporation with subchapter C earnings and profits. But I guess the last reason, and I think that's a very strong reason why we'll just incorporate, and then if things change, we'll just go back. Well, it's not so easy to go back. But finally, again, and I guess I should express that these are my views, not the views of my firm. So I think it is extremely important that there at least be one form, if not more, partnerships and S corporations, whereby small and family-owned businesses can operate and have the entrepreneurial profits of that business subject to a single level of tax, and also not be subject to unlimited payroll taxes as long as those earnings aren't attributable to the personal services being rendered by the shareholder, partner, employees of that entity.
So how would you make that distinction?
How would I make the decision to what?
The distinction between the business income and the employment income.
Well, that's a tough question. And I'm not sure I have a great answer for that. But it really comes back to what I said earlier is, if I earn wages from an operating business I'm conducting, what's the difference? Those aren't subject to double tax, but they are subject to a higher level of tax right now. But what's the difference in that than the remaining profits in the business? They're all generated as a result of an active operating business.
So you wouldn't distinguish between the business profits and you tax them all at a single rate?
If I had my way, that would be true, but I think I'm pretty much in the minority on that.
So where do you see, if you wouldn't recommend, even if the corporate rate went way down, you may be or maybe not, depending on how the rates played out, you may or may not tell your clients incorporate to be able to take advantage of the lower rate because of all the reasons you just mentioned. What do you think is a sweet spot for, but pass-through businesses say, well, you can't do corporate reform without pass-through reform because that's not fair.
The fair word.
Right. What's the sweet spot then for, how much do you have to lower the rates? And you don't want to distinguish between business profits and wage income. And so think all pass-through income should be taxed at a single rate. How low do the pass-through rates have to go in order to get to a meaningful reduction of corporate tax that the pass-through community accepts?
Well, I think it's really about trying to get things on equal ground or similar ground, at least. Equitable ground, right. Excellent word, thank you. And just try to get, so that there's really not this huge disadvantage or disparity between the type of entity. And of course, the type of entity, we seem to be focusing like on tax is the only part of it, right? As all of you know better than anyone, a lot of this is about the legal entity and why you choose it and the benefits and drawbacks of each different form of ownership in a partnership or an LLC or an S corporation and those a corporation, those kind of things. So, generally that's what drives it first. And then, we also obviously look at the tax consequences of that to try to better that. But I think it's about trying to make it such that if we just lower corporate tax rates to 15% and we leave partnerships and S corporations at today, which is almost a 40% rate on doing that, that doesn't make sense. And so there has to be some balance of the scales to get it closer to that so that that's not the driving force as to why you choose which legal form of entity that you're going to operate under.
So maybe a corporate rate reduction to low 20s plus some kind of corporate integration, 40% dividends paid deduction. Maybe that gets you there.
Yeah, well, I think that combined with decreased rates on operating businesses through flow-through entities, pass-through entities.
Right, and what little we have seen so far talks about maybe the corporate rate that would go a little bit lower than the business pass-through rate because they would potentially have that second dividend tax, and that the business rate would, say one's 15 and one's 20 for the pass-through rate. I mean, I don't know the magic numbers, and from what I understand, when these, quote, details come out next week or in 2 weeks, they're not going to include rates in those.
Yeah.
Which I don't know if it's going to answer a lot of questions.
Rates or the base, right?
Yeah.
Okay, Deborah, how should expensing factor into tax reform for small businesses?
Well, I think Greg started talking about full expensing, which is one of the topics that is in the blueprint. And we need to remember that when we're talking about small businesses, there is already some code provisions that talk about expenses, and there are already some limitations on how to do those expenses. And I think that the tax reform needs to shift a little bit the focus when talk about full expensing and look at what we already have and maybe change the limitations that already exist in the law in Code Section 179, or we need to look into how that's going to benefit the small businesses and how that can possibly create more jobs and reduce complexity. So when we're talking about reducing complexity, full expensing has the benefits because we are going to have less depreciation schedules, which actually is a very big burden on tax professionals. However, you need to remember also that when we talk about small businesses, we still have to look into the accounting part of it because they still need schedules for it's not a tax depreciation, but they still need to prepare schedules to keep the inventory, keep their machinery. So I think the decrease of complexity on full expensing is not, in my opinion, is not a real argument for full expensing. But I think that we need to start looking at what we have and try to change full expensing from benefiting certain industries because the way it's written right now in the blueprint, for example, which is it's something that is not being approved and has been very discussed politically, but they have the blueprint states that business will be allowed to fully and immediately expense the cost of investments in tangible property, such as equipment and buildings, intangible assets, such as intellectual property, but not land. When you look at that, you see equipment and building. So you clearly see an incentive or an open loophole for real estate companies. Then you look at intangibles, and you think about how this full expensing is really going to work for startup companies. It can be good for startups, full expensing of an IP. So I think that when we are looking into this full expensing, there are several different items that needs to be taken into consideration. And in my opinion, it's going to be hard with the politics that are happening right now to not to create something that is the same across the board. Because to get that result, I think that we should look into what we have in the tax code and make that better instead of completely wipe it out. Okay, so in my opinion, we should start by looking to Section 179, changing the limitations or excluding the limitations, and that will benefit small businesses. But I don't think that completely expensing everything would be the best. I think it's just another tax break that will benefit certain industries.
Well, it does. It benefits, manufacturers that buy a lot of equipment. It benefits them. Service firms like, accounting firms and law firms. I mean, what do we have? We've got payroll. We lease the computers. We don't own those. We have lease office space. We don't do that. So, there's not a whole lot to do in those kind of industries. So it just depends on it. But you made an excellent point, Deborah, about, when you talk about small businesses, when she mentioned the Section 179, that's just a code section that lets you write off certain expenses, and that's geared towards small businesses. And the way that it's defined in there is up to a certain amount, right? So if you put in I don't know if it's $2 million a year or so, it's around that number. If you put in more than that, you don't get the benefit of it. So you have to be a business that's deploying less capital to get the benefit of something like that.
And I just think I'll mention, I do believe Professor McMahon has written an article about how basically you could almost zero out your income and get a better result with a C corporation with the bonus depreciation and the 179 expensing. And, that's an interesting point.
So why do you think a lot of the Republican leadership is so focused on full expensing for all businesses, even though, and there some people have written on this, it's not even clear that large businesses are at all interested in full expensing because it doesn't show up as a benefit for financial statement purposes. And so expanding 179, as Deborah talked about, it could possibly be a very big benefit for non-public companies. But why are they so focused on this when big business isn't even supportive of it at all?
Yeah, I mean, certainly for like a public C corporation, it's a cash flow item, but it's not an income item. They don't
Right.
care because it's
Right.
not. It's just going to be a timing and a lot of timing issues, meaning whether I deduct it today or deduct it in the future for financial accounting, which is what's reported, through the SEC and what earnings are based on. It really has little impact
Yeah.
on there, and those provisions probably wouldn't apply. And then you look at, you mentioned startups. I don't know that it really even helps startups. Most startups I know lose money. So they're going to lose more because they wrote off of that. How's that going to help them? In some ways, not doing it and having that deduction over future years may keep some deductions fresher longer. Might preserve them into the future. So it can have benefit there. But certainly, for a small business that's making decent money and has the ability to, they're going to go spend $1,000 on a new cooker for their restaurant. And they can take that $1,000 deduction, not pay tax on that amount, kind of a phantom income that they'd pay tax on. It helps there.
Yeah, I think this timing issue on the full expensing is going to help to a certain extent because you're going to be creating losses that can be used in the future, and you're going to be freeing up some capital that you could potentially reinvest, but that's not really true on multinationals, for example, very big corporations. So I don't think it's clear what the intention is, but it's definitely focused on certain industries. And I think that there's some industries that are strong into this that will get some benefit. My concern is when you do full expensing without addressing amortization of intangibles, and you're trying to make the U.S. more attractive to investments and to intellectual property, what's the benefit here? Like, we need to really focus on how we're going to be more attractive to investors, but I think that looking to 1 year instead of, it's not the best choice.
And it's not simple. It sounds like it's simple, But now look at when we had this thing called bonus depreciation, where you could write off either 50% or 100%. This has been in play for the last few years. Well, guess who doesn't like those things? The states. And so you've got companies that do business across, all the states, and everyone has a different set of rules. Oftentimes they piggyback off the starting point, which is the federal, adjusted income, and start there. But then there's a point at which they say, no thanks. And on this depreciation, on the bonus depreciation, that was one of them. So you have to keep depreciation records for your financial set of books, for your federal set of books, and then for every state that you do business in, it can be different. And so, something like this would continue to perpetuate that. And so not sure that's simple.
Yeah. And Greg, I think you bring up a good point when you start talking about state law taxes. When we were previously talking about why not incorporate, I mentioned the double level of tax. Well, again, very state specific, but many states do not impose taxes on flow-through entities, but they do impose taxes on C corporations. And I don't think they're going to get on this bandwagon with the money and deficits they're sustaining and eliminate those taxes themselves.
Our state being one of them.
Our
Right?
state
Yeah.
being one of them.
Because, and Ariel, you didn't really ask us about interest expense, but it's
Sure.
closely tied into business expensing. And also what I was hearing was, originally the blueprint that came out last year would have denied net interest expense in favor of much lower rates of going to a cash flow system. And pretty much every person testifying at all these hearings is talking about how terrible it would be if we disallowed interest expense deductions and how businesses would just collapse. They didn't say that exactly, but it would be just the end of the world. And how could we possibly limit interest expense? Whole industries depend on the ability to deduct interest expense. And so how does that play out in terms of the desire for lower rates for pass-throughs and simplification? And because lots of small businesses, they live by taking out loans, right? So how does all that come into play?
In my opinion, we should not take out the interest deduction because of when we're talking about small businesses. But it needs to be looked into conjunction with the reduction of the rate. So I think it's full expensing, interest deduction, and the lower rate. That needs to be all analyzed together to make sense and to be beneficial for small businesses.
So keep it.
Tend to agree with that.
Deborah, should the U.S. consider a VAT, value-added tax? To try to shift maybe a little bit?
Well, I know a lot of you might not agree with me, but I think no. I think the U.S. should not consider VAT, but there is a lot of discussions every time we talk about tax reform. The U.S. is one of the countries that do not have VAT, and if you look into the revenues that the U.S. is generating from taxes, we are going to see that consumption taxes in the U.S. has very small amount of consumption tax, and they always compare to the income tax revenues that are generated from especially individual tax returns like we discussed before. But when we look into the OECD countries, consumption taxes are the biggest source of revenues for them. But the U.S. is very different from the European countries, and in my opinion, to have a VAT system would not resolve our problems, would actually exacerbate our problems, and it would create more burden on the poor people and the lower income people. And
More of
it
a
would be
regressive tax than a progressive tax.
exactly. I think the benefits would not outweigh the risks because everybody can see. I was discussing with one of my colleagues earlier. There's a lot of discussions on the European Union in regards to VAT. There is several new cases on VAT issues that are happening in the European Union. So I think that it's not the best way. And of course, when we talk about tax reform, VAT is one of the options that a lot of people have been thinking, and you can see in that destination tax discussion that we had a little bit before, where they were trying to put a VAT income tax in place, which also was not going to work. So in my opinion, the U.S. should not create a VAT, but I would love to hear from my panelists.
So I think that your answer is fascinating, Deborah, because the trend among policymakers, analysts, economists, and many politicians now is to say that the U.S. does need to adopt some form of consumption tax. And I don't have the quote written down, but Senator Cardin, who has proposed a consumption tax in the past, made this comment at this morning's hearing, saying that you can't really lower the rates and not increase the deficit unless, and the whole point of lowering the rate in the corporate context, the whole argument most often used for the need to lower the rates is to have U.S. businesses be competitive with that of the rest of the world. So you can't have an income tax that's competitive, a business income tax that's competitive with the rest of the world without turning to the same sources of revenue that the rest of the world is looking at, and that one of those key sources of revenue is the VAT, consumption tax. And so I think that's a valid point. I mean, there are other non-income tax sources like a carbon tax, which is completely off the radar for most politicians, Republicans and Democrats, except a couple of Democrats have proposed another version recently. But so your answer is fascinating as talking about a more realistic perspective about what benefits other countries are actually getting from a VAT. And maybe the answer is we don't want to go there for policy reasons as well. So the general consensus, I think, is policymakers think of that as the right tool, but if there's some kind of and Bob used this term in the panel we did in Brazil, some kind of perceived wisdom that a VAT is a death knell for any politician who proposes it.
Right.
Yeah, and I was about to say, I'm originally from Brazil, and from practical experience, VAT is not the best solution. It looks great in paper. It looks like you have the revenues to fix the deficit that would be created by lowering the other rates. But at the end of the day, it's a tax that is not as clear as income tax because of the credit system that comes with the VAT. And there's a lot of room for discussions, legal battles. And I think that the cost for the government would be increasingly higher. So I think that before changing the tax reform to discuss VAT, we need to look more into broadening the base or fixing loopholes rather than changing the whole discussion to another type of tax. But I know I'm in the I disagree with several practitioners.
You're in the majority on the political side for sure. But it's a helpful reality check on kind of the theoretical thinking of kind of more academic economists. So.
Okay. Greg, what about sort of a hybrid? Should the U.S. consider a shareholder level minimum tax for U.S. individuals?
So for foreign companies that they own, or?
Yes, for the foreign source income, yes.
Yeah, well, I guess just hearing the word minimum tax, I oftentimes have trouble with because I don't know what that means and why you have something like that. But certainly I think it's just part of the broader reform that we're looking at on earnings that are being moved offshore because that's tax favorable and it's job favorable in a lot of those jurisdictions today to do those things. And so I think by swinging the pendulum a bit back so that we have a situation where people don't have to go offshore, companies don't have to go there to be able to, be competitive and be able to sell you that shirt for, $25 instead of $30, and do those kind of things that, to me, that's really where we need to go. And to try to impose any kind of minimums, I think would be very, very arduous and difficult for us to be able to get done. There's going to be all kinds of reasons why it doesn't work, or some person is disadvantaged from something like that. So,
Yeah, I'm not really getting into to that as much as, we started this whole presentation that the focus had been on making, our corporations competitive internationally. And gee, we have I don't know how many times I've heard we have the highest tax rate, in the industrialized world
Highest
on
corporate
C
tax rate.
corporations. Well, I know studies, and you have, 10 studies on one side and 10 studies on the other side, but from what I've seen, the effective tax rate paid by C corporations doesn't nearly come up to the 35% they like to throw around. And it just, got to make you wonder the whole premise for tax reform, at least in that sense. Not to pick on C corporations, but I think that's true.
So I hear that argument all the time, and I think that ignores the extraordinary amount of distortive business planning decisions that are made to avoid
To avoid
that
yeah.
35% rate. And
Exactly.
so the fact that corporations often don't pay 35%, and the ones that don't are often those with a lot of foreign earnings, not the
Yeah,
ones that
that's
are
true.
purely domestic, doesn't mean that we shouldn't get to the right place, because companies are able to get there by spending millions of dollars on planning and putting themselves in very convoluted organizational structures in order to get there. But I didn't know, Ariel, if you were asking here about maybe a territorial tax system, and if that how that might work for pass-throughs, which is something I've been trying to figure out. And also, if you've got a special rate on pass-through business income, how that might apply to foreign earnings of pass-throughs, because pass-throughs earn foreign income also, right? And how that might be treated. If you're going to give a lower rate to business income, do you give it to foreign income of pass-throughs? Nobody knows. Nobody knows.
Well, I guess, but like, if you're just thinking about, okay, we have this country, we have all these countries in the whole world, and all right, like we say that, like the British tax rate or the Irish tax rate, that's sort of like a substitute for the U.S. tax rate. But then, if there's such a discrepancy between that tax rate, like the Irish tax rate and the U.S. tax rate, then how do you capture that? Like, 'cause I mean, it's just not going to be captured. I mean, I don't know how to get at that.
Well, I think the policy question is whether we feel that as the U.S. should try and tax that
Right.
earning. Why necessarily should the U.S. Treasury want to tax earnings of people who happen to reside in the U.S. or companies that happen to be incorporated in the U.S. that earn money overseas? That's
Okay.
You can feel one way or the other about that.
Okay, this is our last question.
Well, before you get to that, can I just, because this ought to,
please.
just, to lay out what we've seen so far and what we're probably expecting to see is we're expecting to see a corporate tax rate that is decreased, probably a broadened base. We've all heard about the business tax rate that will probably be applicable to pass-throughs, that would probably be slightly higher than the corporate tax rate. And I guess what I get out then is, you have all these people saying, all right, how do we prevent wealthy people from gaming the system and getting the pass-through rate? So that's basically what we were talking about before. What does the business rate apply to? And we've said, okay, well, we could pick industries. I don't think that's necessarily equitable. We could use the S corporation approach in the S corporation area. To self-employment taxes, I should say, or Social Security taxes, where as long as you pay reasonable compensation to your shareholder employees, the balance of the profit should be able to be distributed out as dividend distributions subject to that special business tax rate. I would be a proponent of that, but what you hear is that's going to be an administrative nightmare, because how do those cases resolved a lot of times? Litigation. What is reasonable
I think the number of
compensation?
cases on that issue is like this thick.
Right, exactly. So what's an alternative to specifying industries or using the reasonable compensation standard? Well, I mean, one thing I guess that could be used is just an arbitrary standard. And that's what we got when Camp, set forth his proposal. And he just basically said 70% is going to be subject to the self-employment tax, 30% won't be, regardless of the type of business you have, and you could do the same thing with the, quote, business tax rate. Now, I, for one, think that's a horrible way to do it. And I will say, though, I know it's the ABA tax section meeting last May in Washington. I think Mark Warren, who's a tax counsel to the House Ways and Means Committee, you could see that that's certainly the way they want to go. They want to have some sort of objective standard. And afterwards, just kiddingly, he said, well, would you take a 30/70? I said, well, yeah, I might take that, but they're not going to end up there. So it is going to be interesting to see how that is applied, what standards you use, and, again, there's a number of choices.
What about state and local deduction? Where do you think that ends up?
Well, I think the state and local deduction, and it's a cost for flow-through entities that are being borne by individuals. I mean, if you do business as a partnership or an S corp and you sell in 20 different states in the U.S., even though you live in Florida, you think you don't pay tax. You do. You pay tax on your income in every one of those states, and if you don't get a deduction for that, it's an added cost, and it's increased your rate significantly by doing that. And then you have others that live in income tax states, New York, for example, where all their income from everywhere is taxed on there, and that's a big deduction, but it's really not a big deduction because most of them are subject to the alternative minimum tax, which disallows that deduction to start with. So, it's a certain wealth level tax that's paid, because I think a lot of folks that are in a much higher or habitually in AMT, alternative minimum tax, and therefore they don't get the benefit of any of their itemized deductions, really, other than charitable and certain interest.
So it might matter to a lot more people than it's traditionally kind of portrayed as like just a pure blue state.
I think it matters to everyone. Maybe a lot of people in Florida don't care, or Texas or some of the other no personal income tax states, because we're just not focused on it. But yeah, it definitely hits a lot of people.
Yeah, and we need to remember when we are talking about eliminating state and local income tax deductions, businesses that have that deal with in several states, even being small business, that's going to impact them. So it's not a matter of how much revenue you have, how much employees you have, it's where you operate. So that is going to impact everybody. So we need to, sometimes we focus a lot on blue states, and we need to look into not just if the state has state income tax, but we need to look into where the business operate and where those deductions will be meaningful.
So I hear it's not going anywhere. Not being eliminated.
It will be. It could be one form to get to generate the income they need for this reform, but I don't think it will pass.
Yes.
But you could see there's a large constituent that's, as I mentioned, in alternative minimum tax, so they don't get it to start with. And then if it comes away as a deduction, there's a talk of this broadening base, right? This tax rate, when he's talking about that, it means your income that's subject to tax goes up. And so it does, because if you don't get to deduct your state taxes, it goes up. But then some of the provisions have like a doubling of the standard deduction. So for a lot of, middle income taxpayers, that's the substitute for it, right? This doubled of standard deduction. Now you don't need your state tax deduction. So now you've taken care of the lower side. The higher side was kind of indifferent to it, and now you still have some of this middle that you have to deal with, or upper middle perhaps, as to what the benefits that they're going to get at.
So it's still, the question of the deficit is still there. Like, are we making, I mean, we're net lowering the taxes, and what do we do?
Well, don't rain on the parade as to how you pay for all this stuff.
Yeah.
I mean, come on.
That's a good point, yeah.
I don't know. Okay.
Okay.
If you had Speaker Ryan and Chairman Brady or Chairman Hatch on the phone right now, what else would you say to them? As this fall of all the promise of tax reform is in the air and maybe something is going to happen. Have we covered everything?
I would say good luck.
I would say learn how to compromise so you can achieve something. But I don't see it happening.
Yeah, I mean, I think it's really important that this isn't all done behind closed doors. We really need transparency here. We really need well thought out, and I know that maybe is an oxymoron with our politicians, but anyway, it needs to be well thought out. And of course, I would emphasize that, the amount of business, the number of jobs that small business employs who primarily use, again, pass-through entities or sole proprietorships really needs to be taken into consideration in this.
I think it's super important that we get over the finish line with this thing. It's been talked about for quite a long time. There's a lot of things. Look, there's a lot of other stuff that has to happen first. Yeah, this is like one agenda item.
Right.
It's become top agenda right today in what we're talking about, but it's not top. I mean, you've got government funding, you've got debt limit, you've got the flood insurance programs. I mean, those are like the must-dos, and then this is like nice to have after it, but that's what we're focusing on. So, it's easy for all of us, and maybe we talked about what was wrong and what was there. We got to turn that around. We got to talk about what's right, what we can do, not why this doesn't work, but what can work, what we can compromise on, those kind of things. I mean, I think I see posturing for negotiations happening already, which is on some of the rates that are there.
Yeah.
You're not going to get a certain rate, but you throw it out there because you're a good negotiator, and that you're willing to give a little
You'll
bit on those
negotiate
kind of
down,
things.
right.
So, it's important, I think, that the tweaking the rates, what the rate is, whether we're getting rid of a deduction or not, those are the negotiation things. I think if we can come out with a blueprint, or if we can come out with an outline next week that allows that dialogue to start moving forward, and then maybe get some general agreements that they can then negotiate on specifics, there's a chance.
And if we could only keep the lobbyist out of it,
Yeah.
which will never happen.
So I was joking a little before, but the article I wrote last week for Tax Notes International said if we don't have tax reform, then we will wake up and find we've got no corporate tax base left. And that's more of a point on the international
It
large
is.
business side than the small business side. But if we get all hung up in everyone trying to protect their favorite deduction, other countries seem to be more effective in getting legislation passed than we are. And they are aggressively pursuing what they view as unfair taxation in their own countries of the profits of U.S. companies, and they're enacting laws to try and tax them. And so once all that is done, if we haven't acted and we can't act, then guess what? There's no more revenue for us because our multinationals are claiming a lot more foreign tax credits when they bring money back. So don't act at your own peril, or at all of our own peril.
All right. So it's a good time to open it up for questions from our audience members,
Our
soon to be
distinguished audience.
from our distinguished audience and potential participants. So just a reminder that we're on the record. When we recognize you to speak, just let us know who you are and what organization you're with.
It's my class.
Which classroom?
Okay. And
Any
Shannon,
IRS agents in here?
Shannon's going to bring you the microphone.
Treasury officials?
Hey, how's it going? Thank y'all for coming today. I appreciate it. My name is Greg, student at the University of Florida. Y'all in the beginning touched on some of the full expensing, and in the Better Way tax policy paper, throughout it they mention that they'd like to move towards a cash flow base for businesses. And I was just curious what y'all's perspective on the viability of that is, as well as the potential implications on everything you talked about previously, such as deductions, expensing, source income, how that would affect it.
I'll start.
Great.
So, a cash-based system, obviously, there's many companies that are on cash basis, and it's an appropriate
He's talking about cash
cash
flow.
flow, right? But cash flow. So you take in, without you have a food truck, and you take in
Right.
$1,000, and you buy a new refrigerator for it for $200. The idea is you don't have that $200 anymore, and you'd like the full tax benefit. If you're in the 40% bracket, it's $80 that you'd get. In doing that, if you can't take that full expensing of it, you probably only get to deduct $20 of it or so in the first year, and then you only got an $8 deduction for it. But yet you're out this $200, right? So so for a lot of businesses that can do that and can write those off or have the ability to do that either through the current system, because that exists today in a regard, but to allow that for all, and to allow that for all on a cash flow basis, in doing that, it encourages that spending, right? It encourages you to deploy that dollar of capital I talked about earlier on that expenditure, because of the benefit that you can get. Obviously, you need it in your business. You're not going to do it just for that. But I think, it does help spur that type of spending. We saw that when we had, bonus depreciation, where you could write off everything. I do a lot of work with people that own private aircraft and stuff like that. People would buy $40 million airplanes, and you could write them all off in 1 year. Back a few years ago, now you can write 20 million of them off. It's not as good, but so it encouraged spending. I saw that.
From an accounting standpoint, you being an accountant, that certainly leads to the mismatching of income and expenses, which I don't know if is a good goal or not. Uh-oh, now we're in trouble.
Marty McMahon, retired UF.
Retired.
Following up on the prior question, the classic cash flow business tax goes back many years. The best written exposition of it was by David Bradford, Princeton University economist, in his book, The X Tax. But even before he published The X Tax, he was the brains behind Blueprints for Basic Tax Reform, published in 1969, when he was the Assistant Secretary for Tax Policy under Gerald Ford. And the cash flow tax does have full expensing, and it does have full deductibility of interest. But it includes all borrowing in income and allows a full deduction for loan amortization. The result is that there is an immediate net tax deduction for equity investment in assets, and there is no immediate tax deduction, net tax deduction, for investing borrowed money. The deduction comes along at the time that the loan is amortized. All right? It is a brilliant system. All right? It is a brilliant system. The problem is that we are so path dependent in this country in looking at tax reform right now that the idea of adopting that true cash flow system cannot be easily considered by the politicians because everybody is locked into the idea that borrowed money is not income. But the idea that borrowed money is not income is inherent in an income tax, but a cash flow tax is not actually an income tax.
Thank you.
Thank you.
I'm just thinking of all the reactions of all the small business owners who were talking about how important their interest expense deductions were to telling them that they're going to be taxed on the money they take out to.
Yeah, I think that's a great system potentially, but I think politically, boy, that would be a hard sell.
Okay. Another one?
Yeah. we're gonna go back and forth.
She needed to.
I need the exercise.
Good afternoon. Michael Williams. I'm also a student at UF now. And I guess my question was, there was some mention about not getting rid of the corporate tax because corporations are such a small number. But would your analysis in that issue change if it was readily identifiable who ultimately pays the corporate tax? Because I know that's something we've discussed. As far as does X corporation pay the tax, or does the consumers pay the tax? Do the shareholders pay that tax?
In my class, we've discussed this.
I want to hear their.
You know, I think I made a comment at the beginning that individuals pay the majority of the tax in the country.
Yeah.
Corporation, that's just the way it works. It wasn't that we should get rid of the corporate tax because of that. It was just that constituent-wise is a smaller group, right? But you know, there is a lot of that tax that's paid through dividends and through the corporations. And so, you know, making them, I guess my viewpoint would be making them more competitive where there's more jobs here in the U.S. and the tax rates are more favorable for them on a global basis, you know, just produces more activity here in the United States that becomes better. And, you know, the idea of, is it lost revenue or do we have increased production that gives you higher revenues? You know, that's what all the scoring is about when they go through and try to do this. I don't know how you predict that stuff. That's what the economists do, I guess.
That's what the economists do, yeah.
My name is Maurice Lamb, and I'm also a UF student. My question is, how would you guys balance the goal of us U.S. corporations trying to remain competitive internationally, but also with the goal of trying to reduce our deficit and raise revenues?
We live in a magical world.
Yes, that magical rule says if you lower the tax and make them more competitive, they'll be making more money and paying more taxes.
We'll have
but
5%
that's-
growth.
Yeah, that's
That's right.
Well, I think,
unrealistic.
yeah, and I think the answer to that question is depends on which side you are analyzing it. If you're in the IRS side or the government side, you want to raise more revenue, so you can look into things like Google tax and increase your base. But if you're on the taxpayer side, you want to keep your tax planning options where you can have less income being taxed here. And going back to what Mindy was talking about earlier, the actions the U.S. has to take from a government perspective is we need to determine how to protect our base, the income from those corporations, the income that is abroad, before everybody else gets that piece. Because we have several cases that are happening right now, the Apple case, Google tax, Amazon case. So it's time to act now to protect that. But how to do that is a question that I'm not really sure how that's going to be resolved.
And this doesn't just apply to international tax, but I think we've continuously seen a lack of resources made available to the IRS, decreasing budgets. And one of the things is there is a lot of money out there. There's a lot of uncollected taxes. And if they could just collect the taxes that are due, I guess that's the quote tax gap between what's paid and or what's owed and what's paid, I think that'd go a long way in international and domestic taxation to help things out.
Yeah, or even maybe not what's due, but by changing the law and allowing repatriation to come in at a more favorable rate,
Right.
bringing money back will
Sure.
then generate revenues here in the U.S. at perhaps a lower rate than otherwise, but the otherwise is probably years away, if ever.
Yeah.
And Mindy, I think I'm not really sure if you are like this idea, but do you know if it would be possible to impose a minimum tax on the amounts that are abroad? For example, in Brazil, certain CFC rules, they have to report their income from abroad and tax in the country every end of the year. Would something like that work in the U.S. In a lower rate, or
So there have been proposals like the President Obama proposed something like a minimum tax, and depending, we have Subpart F rules here, which you're familiar with. Depending on how tight you wanted to make those controlled foreign corporation rules, it could approach looking something like a minimum tax. Republicans certainly don't like the term minimum tax, but actually President Trump's initial tax reform plan included a minimum tax on foreign earnings at a much lower rate. I think whatever is enacted will likely include some lower tax rate on foreign earnings, but tax some portion of it. So even when people talk about going to a territorial system, which they will probably propose, that's my prediction in the next couple of weeks, it will still, which is supposed to exempt dividends from foreign earnings, it will likely protect that through some form of minimum tax on some kinds of foreign earnings. It might be limited to passive foreign earnings, but we'll see whether, even if it's proposed, whether it could be enacted.
Thank you. My name is Dalton. I'm a S.J.D. student here in at UF. And I have not been reading much about the tax reform, so I apologize in advance if my question is not appropriate. But I think the biggest problem in every tax reform is the transition between the current system and the new proposal. And I don't see many comments or articles in the press about this transition. Do you know if the Trump proposal has some proposals about that transition between of course, the proposal will be approved?
Yeah,
Because,
first, thank you for saying that you haven't been following it that much, because, I mean, I bet a lot of people haven't. I mean, obviously, we do it because it's our job, and we're doing this on a daily basis. And a lot of people, clients included, ask that question, like, why should I even care about this stuff? It's going to be what it is. Call me when it's done, and tell me what happened. And kind of the point is, no, it really, you can have a voice in this. You can understand what's going on. You can understand how you're going to be impacted by it. And we sit down with our clients, we did it last year, and, didn't need to, but we'll do it again this year, as to if these kind of provisions go through, this is what it means to you. And if you sit down with someone and say what it means to you, and it's a number with a lot of commas or a lot of dollar signs or zeros on there, they're going to take more attention to it and pay more attention to it, and I think have more of a voice in there. So anyways, that was just an aside. But I don't think this is, that was maybe a political statement. This is not, I don't think a barn door is going to slam shut one day. We're going to have new rates. So I think all of these things, and you're right, it hasn't really been focused on. It's there, but it's not been focused on. I think there's transitions on these things. There can be, the rates may go to 20% over, and go to 20%. That's the headline. The footnote is over the next 4 years, and so that's out there. And in the different provisions, there are different phase-ins of some of these provisions.
But there was some stuff written on what a transition might look like when the Republican blueprint and a destination-based cash flow tax was being taken more seriously. There were a lot of questions raised about how that transition might go. I think one of the reasons you're not seeing anything about transition now is that there are no concrete proposals.
We don't know what we're transitioning to.
Exactly.
And once again, it goes back to the fact that the US system is a little bit different, because if you look at certain countries like Chile, when they change a tax legislation, they're going to say, by 2020, our income tax rate is going to be this. In the US, you're not going to see that be very clear. So it's the legislative process is a little bit different. So we need to understand that too.
One thing that was brought up early was the estate tax. I think you brought it up. And again, personal opinion, at this point, I don't think they're going to do anything to the estate tax. I don't think it's going to get repealed. I don't think they're going to mess with the exemptions or credit amounts. And that's just how I feel. I don't know, Greg, you?
Well, I was telling Mindy, I was on the ride up here today. Actually, my phone rang, and it was one of my clients. He's older. He's about 90 or so. OK Health, and he said, "Hey, what's going on in D.C. about this estate tax?" And I said, "Don't die. You don't need to be worried about dying in the next 4 years. I mean, it's a bad answer for you either way. So don't do that." But and I think the other point is, even if it were to go away and be repealed, again, this is, you talk about small constituents, right? The amount of people that pay estate tax is, half of 1%, a very small number or so. So it's not a big group of people. The dollars are reasonably okay, but they're not big revenue raisers. But as I told my clients, because I do this type of planning, and they said, "Well, should we wait?" I said, "Absolutely not." I said, again, no, wait to do the planning. Yeah.
Yeah, wait to die.
I always advise them to wait to die. I find that to be very good advice. But I say the reason for doing a lot of that planning isn't even about the estate tax half the time. It's about control and flexibility and those kind of things of your wealth over a period of time. But more importantly, in 4 years, if it did get repealed in 4 years or 8 years, depending on what happens, it may come back again, unless you're planning on checking out in that period of time, which most people won't voluntarily want to do. We need to keep planning. So,
Agree.
Okay, I think this is going to be our last question, so thank you.
No pressure.
No pressure. This is going to be
Okay. My name is Laurie Ann Foraker Gardner. I'm a 2006 graduate of the L.LM program here. I actually have an international tax degree, but I practice regular real law about an hour up the road. So I get to come here and hear these great talks. And I have a lot of I don't want to call them the true small business clients, but they're the true small business clients where I live. And one of the things that I had the honor of having the late Paul McDaniel for some of my international classes. And he didn't draw a lot of conclusions for us, but there was one thing he did say to us one day in class that I've never forgotten. And he said, after all these years of analyzing all these different kinds of proposals, and he would be consulting other countries on what kinds of, tax policy they should have. He said, "I will tell you this. I think this is always true. And that is, as you increase simplicity, you will decrease fairness at the margins." And that ties into what Dalton's talking about. And that is where almost any time, a lot of the way you pay for these changes is that you're supposed to get a one-time hit when you transition. I learned that from Professor McMahon. You're supposed to get that one-time switch that helps to pay for this. And what happens is, as you begin to talk about these things, people start softening the blow. And the more they soften the blow, we don't want it to hit this group, and we don't want it to hit that group. And then suddenly the price tag is not going down, but the costs are not going to get paid for anywhere near like what you proposed. And so I already see that happen with territorial tax. That was all great. That's been in the blueprint for over a year. But all of a sudden, other people on the Hill are hearing this and going, "How does that work? Oh, you get a one-time hit, but no, you're not going to hit my people one time." And so I think that's important for people like you to help others understand. For example, the estate tax was repealed for a year. I had clients in that year that would have had tax that they would not otherwise have because of how they paid for that. And that's what carryover basis. I would really like to know if the next time we have to endure federal and state tax repeal, will we also be enduring carryover basis? Because for the people I represent, that matters. They might have never had to file a single form with the IRS. They would have never owed any federal estate tax, but suddenly they're just close enough that I've got to at least tell you everything I own and where I'm putting my basis. And so those are increased costs that don't get talked about because they're not the high-end people.
And that was the one year that was the exception to the rule and advising them not to die.
That was a lot
the year
of
my tax professor died.
Okay. Before everybody leaves, I invite at least the students to pick up information about Tax Analysts' annual student writing competition. It's on the cookie table back there. Or you can feel free to ask me about it after we adjourn here. And I'd like to thank Mindy, Greg, Steve, and Debora for a great panel.
Pleasure to be here.
Okay, that's it. Have a great evening, everybody.
Thank you. Thanks for that.
Thank you.
It's good. Nice to meet you.
Very nice to meet you.
Want to meet some of my students?
Sure.
Will ask you questions?
Very
Good job.
good
Great
job.
job.
My hands are still
No,
shaking.
you were doing
Came
it.
across a million times.
You were on, yeah.
Than anyone else.
My hands are still cold.
Thank you very much. Nice to meet you. Sure.
She did a lot, I did a lot of talking with her.
One of my students?
Hey, Ariel. Nice to meet you. Yeah. Thanks for asking the question.
Yeah, you were very interesting. Yeah.
Well, I know.
Yeah, she's good people. For sure, for sure. That's great. Well, thanks a lot.
Well, again, thank you.
Hi. Fine, how are you? I remember meeting you in DC, and I thought that you were Dean Zerby, and that was so embarrassing. But anyway. And this is, I love the bow tie. Whatever. So, when in Rome. Thank you. I owe a lot to the communications team at Tax Analysts, and yeah, they were great. And the panel, it was really the rhythm was really good, and
I would have done it